Hello, it's Marc Ostwald from ADM Investor Services International with some thoughts on the Federal Reserve and the US Q3 earnings season. We have obviously a Federal Reserve meeting on interest rates next week. Markets discounting, as one can see from this table, a more than 90% chance of a Fed rate cut. That's despite the fact that actually the narrative from many Fed speakers has been that they're not actually sold on the idea that they need to cut any further, given that incoming data outside of the manufacturing sector continues to be reasonably robust. And perhaps the more important aspect is, as much as the Fed is unlikely to disappoint markets for the sheer fear that it will actually create a lot of volatility, and having had that experience last year with all the volatility in both equity market and bond markets, it's probably not wanting to be responsible for a renewed bout this year. But obviously the more important aspect of what we've got next week is what's happening with the Federal Reserve's open market operations, because obviously next week is also the end of the month, and so they've been starting to ramp up their open market operations. So let's have a look at my next chart. It's a strange sort of chart because obviously we've got this huge gap between 2008 and 2019, where there were no open market operations, largely because the Fed injected all that QE and then started to wind back its balance sheet. But as we've seen, the level of bank reserves are too low at the Federal Reserve, and so it's now fighting a rearguard action to try and rebuild the level of cash reserves at banks and finding better uses for them within the repo market. So that is what they offer there in terms of a solution is also very important in terms of how we pan out in terms of the rest of the market during the earnings season. So let's go over now to the earnings season, and I think there's sort of some longer-term observations here. First of all, let's have a look at this particular chart. The blue line is the performance of the S&P 500, and the yellow line is the performance of US after-tax corporate profits in billions terms. As one can see, there hasn't actually been a huge amount of improvement, particularly when one compares it relative to the performance of the S&P 500. And as one can also see, some of the bigger setbacks in the equity market have come when those two metrics have actually diverged and not quite as sharply as they are at the moment. So that takes me to the next two charts, which are about speculative grade and leveraged loan ratings. What we're seeing here, unsurprisingly, and this is going to be important, and I'll come to why in a moment as we go forward, what we're seeing is the amount of downgrades is certainly outstripping the amount of upgrades that we're seeing in high yield bonds. That's this particular chart. And so the net upgrade level now is quite sharply in negative territory. If we go to my final chart, that is on leveraged loans. What one can see here is the overall level of downgrades relative to upgrades is basically still fairly static. But in terms of leveraged loans, we're actually seeing a very sharp rise here. And as much as people say this is a necessary part of the market, I think the more important point here is that the era of financial repression has pushed a lot of people into these sort of illiquid assets. And if we do have a sharp downturn in the equity market, for whatever reasons, then people exiting this could actually create quite a lot of problems. It's something just to bear in mind as we go forward. And that's the thoughts for this week.